Are you making these 7 mistakes when investing? Let's get straight to it. Mistake number 1, investing without clear objectives. It's incredible how many individuals invest without first determining their goals. It's the same as getting in your car and driving off without knowing where you're going. You must examine this before you even consider investing. Are you looking for capital growth or income, for instance? For example, you're in a job and your salary is very high, which is more than enough to cover your monthly expenses, but you want a bigger house. Your income is sufficient to support the mortgage on a larger house, but you don't currently have the capital required for the increased deposit. You therefore wouldn't necessarily focus on cash-flowing investment strategies. What's needed is to generate a larger pot of capital to make that house move possible. So, start with the end in mind and work backwards. Think about what you actually need and quantify the what and when. This ultimately tells you why you are investing. Mistake number 2, neglecting due diligence. Due diligence is often neglected by investors because they are either unsure of where to begin or think it's not essential. Any investment choice must include due diligence, and skipping it will cost money. Neglecting due diligence is a failure to conduct a comprehensive evaluation of a possible investment or business opportunity. As a result, it's possible to ignore crucial information, make bad judgments, and maybe suffer substantial financial losses. To guarantee that investments are made with a complete awareness of all the essential information and dangers involved, research is a crucial phase in the decision-making process and should not be disregarded. So, do your own in-depth, independent research. Mistake number 3, not reinvesting your returns. Your wealth will be magnified by reinvesting and compounding your returns. Einstein called it the 8th wonder of the world. Compounding interest refers to the process by which an asset's earnings are reinvested interest, resulting in an increased interest earned. This generates a snowball effect, where the interest earned on an investment compounds over time, leading to exponential growth in the value of the investment. The frequency of compounding can vary, but the more frequent the compounding, the faster the investment will grow. A common mistake is to spend your investment income instead of reinvesting it. This stops you from benefiting from compounding. So, reinvest your income, then let compounding work its magic. Quick message to say, if you're enjoying the channel, it would mean a great deal to us if you like and subscribe. Mistake number 4, chasing shiny pennies or jumping onto the latest bandwagon. Warren Buffett said to be fearful when others are greedy and greedy when others are fearful. The best investment over the long term is to stick with dependable income-generating investments that compound over the long term. Jumping from strategy to strategy can lead to a lack of concentration or attention on a specific task or goal. This can result in decreased productivity, lower quality work, missed deadlines, and potential mistakes. To be successful, it is important to maintain focus and give full attention to the task at hand. Don't get swayed by hype and fear of missing out. Mistake number 5, poor tax planning. Many investors do not invest in a tax-efficient manner. Your ISA allowance and pension are 2 obvious ways to invest in a tax-efficient way. Outside of such wrappers, you could be liable for income tax and capital gains tax, or corporation tax if within a company. Your accountant or tax advisor can provide much more detailed advice on tax efficiency. The limit on how much you can invest is currently £20,000 per annum per person. So, a couple can put £40,000 into an ISA, and if you have children, you can invest for them too. So get the most of your yearly ISA allowance. If you've already done that, get expert advice on how to invest the remaining funds most effectively. The long-term benefits of paying for tax guidance much outweigh any initial costs. Mistake number 6, not diversifying. Diversification is an investment strategy aimed at spreading risk by allocating investments across a variety of different assets, industries, and geographic regions. The idea behind diversification is that a portfolio containing a mix of investments is less volatile and risky than one that is heavily invested in a single asset or market sector. By spreading investments across multiple assets, an investor can reduce the impact of negative events in any one area and potentially achieve a more stable and consistent return over time. Diversification is a key principle of modern portfolio theory and is considered an important tool for managing investment risk. Mistake number 7. Failing to invest. History shows this to be a long-term mistake. There are always more excuses not to invest than reasons to invest. Not investing can result in your cash losing value through inflation. This can result in missing out on opportunities for wealth creation and potentially missing long-term financial goals. Investing even a small amount has the potential to grow over time due to compounding and the power of earning returns on returns. It is important to consider investing as part of a comprehensive financial plan and to seek professional advice if needed. If you're considering buying a house, we discuss in our next video whether or not now is the best time to buy.